Okay, so a very quick recap of our journey. Since the middle of November until April, I've been giving warning signs in my videos signaling a potential correction due to high CPI, push for a rate cut despite the high inflation, tariff implementation which may lead to a high inflation, and strong key data including ISM, PMI, and consumer confidence. In early April, I said that it's time for us to consider buying into the market given the lower valuation, political noise which goes away quite quickly, and the potential rate cut in the second half of 2025, which may boost market valuation. Post-April, I gave a few more rounds of market updates explaining why the market is hitting the all-time highs, as well as some thoughts which may be going on inside Trump and Powell's heads. I also walked through some of the key events that are happening in the market, including the big beautiful bill, the tariff, stablecoins, and the Federal Reserve's reactions to the market. Okay, and last week, I gave another market update explaining about the three puts which is acting as the line of defense for the stock market. The three puts were the Treasury put, Trump put, and the Federal Reserve put. I explained that the Treasury put was provided through the one big beautiful bill, the Trump put was provided by the 90-day pause on the tariff, and the Federal Reserve put may be provided by lowering the interest rate. I also noted that the Fed put is extremely important for the market given the Treasury put and the Trump put are losing steam. Therefore, I said that in order for the market to continue to go up, the market needs comfort on three areas, which are, number one, a stronger Fed put, i.e. 3 rate cuts rather than 1 or 2 within the year, and number two, SLR deregulation being implemented within the year, i.e. a stronger Treasury put, and number three, companies' earnings continuing to outperform. Okay, so while those were my explanations, the first step towards the Fed put was held recently at the Jackson Hole. Now, everyone saw what happened in the market, so you all know that the Fed gave a lot of comfort to the market that they will be cutting the rates in September. Now, to summarize what happened, basically there were a strong conflict between Trump, Bessent, and Powell on the interpretation of the unemployment rate and inflation. On the unemployment, Trump, Bessent were of the view that recent unemployment data, which is showing upticks in jobless claims, is a proof that the job market is bad, and therefore we need to lower the interest rate. Powell's view was that around 4% unemployment rate represents a very stable and balanced job market, and therefore lowering the interest rate because of the unemployment is not rational. Now, on the inflation, I already explained this in my previous video, but Trump and Bessent have been continuously saying that tariff impact on inflation is only a one-off event, and not lowering the rates because of the concerns over tariff is not fair. Powell's view was that the tariff impact on inflation is something which takes time for us to understand, and lowering the interest rate now is not a smart thing to do. Now, first on inflation, I explained in my previous video that Powell changed his stance at the press conference in late July. He admitted that the base case impact of the tariff on the inflation is most likely a one-off event, which is basically siding with Trump and Bessent. This was a big surprise to me, as this was the first time Powell expressed his opinion on the tariff, and what he said was more or less aligned with Trump and Bessent. Okay, so basically, this is what made the market happy on the tariff front. Now, back on the unemployment, the reason the market showed a positive movement on the day of the Jackson Hole was because Powell expressed his thoughts, which kind of revoked his previous stance, basically siding again with Trump and Bessent. This is the quote from Powell's speech. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to unemployment are rising, and if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. Now, in the quote, please pay attention to the word in the middle which says curious kind of balance. Now, what this basically means is that while Powell is saying that the unemployment situation is somewhat balanced, it does raise questions on why the labor market is acting that way. He's basically saying that the reason the job market is stable at the moment is because both supply and demand of labor are moving slow, and therefore, if the demand side of the job market goes back to being normal and fails to catch up with the supply of the job market, the unemployment situation may break any minute. He then went on saying that this unusual situation suggests that downside risks to unemployment are rising. Okay, in short, Powell is basically saying that he's seeing risks in the job market, which indirectly means that he needs to lower the interest rate. Okay, so basically, Powell is now aligned with Trump and Bessent on both the unemployment and tariff. This is why the market went up quite a bit after the Jackson Hole speech. Okay, so that's clear, and what I just said are all over YouTube and the news. Now, what I want to focus on today is on why the market is not going frenzy with the Jackson Hole speech and only ended up going up for one day. So I do agree that the Jackson Hole speech was a good news for the market in general, but why didn't the market go up even more after the news? I mean, the September rate cut is now guaranteed, and as I said previously, multiple rate cuts are now much more likely than it was, right? Also, as I explained last time, Trump is all over restructuring the Federal Reserve's board members to decrease the interest rate. He replaced Kugler with Myron and is now trying to replace Lisa Cook from the board as well. Basically, Trump is doing everything he can to lower the interest rate, but the market is not reacting much. Now, why is this? Now, I can think of around 3 reasons for this. First reason is simple. It's the market's valuation. From early April, Nasdaq and other major indices increased by around 30% from its forward price-to-earnings ratio now reaching around 30 times. Based on the historical valuation level, the current level is not an easy valuation for the market to swallow, so the market needs some comfort that the future earnings of companies will continue to perform well. Second reason is market's credibility towards the Federal Reserve's monetary policies. Now, the recent actions taken by Trump replacing certain board members of the Fed was to accomplish the Treasury agenda of decreasing the fiscal deficits and trade deficits. While this is understandable, by law, the US government, the Treasury, and the Federal Reserve needs to function independently to guarantee prudent decisions made by each of the entities to accomplish their independent agenda. The reason the market thinks of the Federal Reserve put as a real put is because the market believes that the Fed is making decisions based on their independent analysis and interpretation of data. For example, if the Federal Reserve signals a rate cut, the market believes that the Fed is making such decision because they really believe cutting the rate is actually necessary and reacts accordingly. However, if the market starts to question the genuineness of the Fed's decisions, the market will start thinking that it's not a real put, but something which may backfire sometime in the future. For example, let's assume you're working at a job and there's this really nice boss. The boss is so nice that whenever you tell the boss that you're going some financial difficulties, the boss lends you money with no interest. You really think the boss is a nice guy and start trusting him as someone you can depend on whenever you're going through hard times. However, one day, you come to realize that the reason the boss is lending you money is because the company had a lending program for the employees, which the boss had access to, and the boss was just giving you money through that lending program. You further come to realize that this lending program is only available when the company is making a lot of profits. Now, when you come to realize this, would you trust and depend on your boss like you used to? You'll basically think that the boss is no longer dependable and also start thinking that this loan you have been getting from the boss will not be available if the company doesn't make a lot of profit. So you will start looking elsewhere where you can borrow the money when things get bad again. I believe this is something which is happening in the market towards the Federal Reserve. The market is happy that the rate cut will happen, but a bit confused how much they can depend on the Fed put, given the market doesn't know if the Fed is making this decision out of their own will. Okay, the third reason is what was announced at the Jackson Hole. While Powell did hint that the September rate cut is likely, he did add a few other things on top of it. Basically, he announced that the Fed has removed 3 things from the Fed statement. Number 1, the effective lower bound feature, and number 2, the makeup strategy, and number 3, the shortfalls. Now, I'll explain what these are and what the removal of these languages mean. First, on the ELB. ELB is an old framework of the Fed's monetary policy which states the lowest practical level for the interest rates, which is typically near 0%. Now, while this may feel restrictive, the market didn't hate the ELB concept because, number 1, if the lowest interest rate the US can adopt is 0%, this means that after the interest rate hits 0, the market can expect other forms of monetary policies such as quantitative easing. And number 2, it gave comfort to the market that if things get really bad, the interest rate will indeed come down to 0. To help you understand this better, let's assume you walk into a bank to get a loan and you see a sign that says the lowest interest rate you will pay on your loan is 0%. How would you feel? You may feel a bit of comfort that someday the interest rate on your loan may actually be lowered to 0%, though not immediate. However, let's say you go to the same bank the next day and you see the sign disappeared. At that moment, you might feel a bit lost and uncertain about the intention of removing the sign. You might think that the bank will never decrease your interest rate to 0% and may panic, thinking that the interest rate may stay high for a long time. Now, this is what the market somewhat felt after they saw the ELB being removed from the Fed statement. Basically, Powell made it clear that such framework will be removed given the different economic conditions. Second, on the makeup strategy. Basically, this is also known as FAIT, which is short for the Flexible Average Inflation Targeting Strategy. Now, this strategy was introduced in 2020, and what this does is, while the Fed will target the 2% inflation level, it'll compensate for the past undershoots of inflation below 2% target. To help you understand this, basically, let's assume the US was going through a low inflation of 1% for 5 consecutive years. However, from year 6, the US's inflation suddenly shoots up to 3%. Now, 3% inflation is really high, so the Fed could definitely consider raising the interest rate to cool down the inflation. However, with the makeup strategy, the Fed will not increase the rates. The reason they would not increase the rates is because the US went through a 1% inflation for 5 years and 3% inflation for only 1 year. If you average the 6 years of inflation, it's still only at around 1.3%. Even if the US records 3% inflation for another year, the average inflation is still at around 1.6%. Now, given both 1.3% and 1.6% are both still below 2%, the Fed will not increase the interest rate. Basically, this strategy was adopted in 2020 to provide a huge comfort to the market that the Fed will not increase the interest rate anytime soon. The market loved this strategy because it gave a lot of comfort that the interest rate will not be increased easily. However, Powell removed the strategy from the statement as well. Third, on the shortfalls. Now, this concept was also introduced during COVID. What this basically does is, while the Fed's role is to control the unemployment from either being too high or being too low, the Fed will not increase the interest rate because the unemployment is too low. If the unemployment rate is too low, i.e. the job market is overheated, the Fed generally gets worried because it may increase the inflation level and therefore has a higher chance of increasing the interest rate. However, with this shortfall mechanism, the Fed is saying that they will not increase the interest rate just because the job market is hot. Now, from the market's perspective, this was also a good to have because they don't have to worry about the overheated job market as long as inflation is under control. However, Powell removed this strategy from the statement as well. Okay, so to summarize, basically, while giving comfort on the short-term interest rate outlook, Powell and the Fed removed 3 things which may negatively impact the long-term outlook of the interest rate. Number 1, they removed ELB. As I explained, removing ELB basically means that the market is now somewhat confused what kind of actions the Fed will take if there's a recession. Number 2, they removed the makeup strategy. As I explained, removing the makeup strategy increases the chances of an interest rate hike when inflation is above the target level. Number 3, they removed the shortfall strategy. As I explained, removing the shortfall strategy forces the market to closely monitor the unemployment rate in accordance with the inflation to predict the interest rate trajectory. With all those reasons, the market is showing a somewhat slow movement in recent days. Now, I do agree that the market valuation level is not cheap. There are some cracks happening in the credibility towards the Fed, and the Fed is also removing some additional cushions from the market. Having that said, I still do believe that what's really key in the current market is whether the market can gain comfort on at least 3 rate cuts within the year, coupled with SLR deregulation. Let's carefully monitor the market, and if we see any meaningful downturn, it may be an opportunity for us to buy more into the market. I hope you enjoyed the video, and I'll be back with more videos very soon.